Morning, everybody. Thank you so much for joining us. I can see there are a couple of guests who are still jumping into the call, so we'll give it one more minute, but thank you to those of you who are dead on time. The purpose of this morning's meeting, and we are going to record and share all recordings and transcripts and presentations with you after the event, but it's just to give you some insight into compliance. So we've got Yolandi here. And also to give you a product update on Sage 300 People. So I think what I'll probably do is hold on for one more second. We've got quite a few of you already in the call, which is great. And then I will pass over, I think, to you, Johan. So, yep, take it away. Thank you.
Cool. Thank you so much, Lucy. Let's give it a minute. I see there's ample people still joining. Right, let's perhaps get started. Good morning, everyone, and thank you so much for joining us in today's session. I see there is quite a number of participants, so I really hope that we can do it justice. Although I do have the Mick Jagger of the compliance world that's taking the lead, so I'm happy that you'll all be very entertained, at least a little bit. For today's session, I'm going to kick us off for today's session. We're going to look at two parts. We're going to look at the compliance changes, what we know, what we don't know. And that will be run by Yolandi Esthuizen, who is our compliance director for global compliance. And then I will take you through the changes that we are including in 300 People that are not related to compliance. Just a high level overview of what you can expect. Right. So Yolandi, I'm going to hand over to you. I'm going to start us off. Thank you so much.
Thanks, Johan. Good everyone. Johan, I don't know if compliance is as entertaining to everyone else as to me, but let's give it a try. So everyone, I just want to give you a quick background on the changes that, well, basically tax changes. There are two areas or elements of tax changes. The one that is usually announced in the budget speech. Now, those are typically our rates, for example, our tax tables, rebates, medical tax credits, travel rates, subsistence rates, ETI brackets, etc. And then there's another element, which is the legislation that is basically already contained in the Taxation Laws Amendment Act and the Tax Administration Laws Amendment Act. Those have already been promulgated, which means it's already legislation. And that is what we're already aware of, and we are prepared for that. So I'm going to run through that so that you're just aware of the changes to expect. So obviously the budget speech side, we are not 100% sure of what to expect, and hopefully it will go ahead tomorrow as planned. So tomorrow we'll only find out about the tax tables, possible ETI changes, medical tax credits, and then obviously the very much debated VAT changes. And then what we do know at this stage, which is usually also announced in the budget speech, is the subsistence rates, the day trip rates, and the cost scale table for us to basically be able to calculate travel allowance. Johan, if you move to the next slide, please. So the rates have basically, I think there we go, thank you. The rates have already been published. I've also added the note at the bottom, or the link to these gazettes. So it's on the SARS website. It's on our community hub. I'm not going to go through the subsistence allowance and day trip allowances in detail. What I do want you to take note of is the rate per kilometer that decrease from R4.84 to R4.76. And what it basically means, you'll remember that the excess, so whatever you pay an employee more than the prescribed rate per kilometer, gets basically caught by the pay-as-you-earn net, and the employee should be taxed on that. So now that the rate have decreased, there would be a bigger portion or excess that will be included in the pay-as-you-earn net. So just prepare your employees for that, make sure they understand the impact, review your rates where necessary. So those are the rates, but the rest we'll find out tomorrow. If you go to the next slide, please, Johan. So what we already know that has changed in terms of the legislation is now what I'm going to run through. There aren't major changes this year, which is good news. Aren't major changes to ETI or any other applications. So one change that you need to be aware of that might impact you significantly. But the rest of the changes will quickly run through. You'll also see this in the communication that's going to go out in the release notes. But if I explain it just briefly, then at least you know what to expect. Now, the first one that doesn't affect systems would be the clarification of remuneration proxy. Now, you'll remember that the remuneration proxy, which is basically last year's remuneration, is used in the calculation of certain fringe benefits. For example, bursaries, low-cost accommodation. So basically to calculate those fringe benefits. Now, in the definition of remuneration proxy of an employee, it refers to an associated institution. Now, this legislation basically now, or the amendment basically just clarifies that if you look at an associated institution, when you need to determine the remuneration proxy, you need to look at the definition as determined in the 7th schedule of the Income Tax Act. So basically what is in the Act itself and not just the normal sense of the word. So it's basically just a clarification. Make sure that you're referring to the correct definition of an associated institution. But it's just a technical change, but so that you're aware of, especially if you are calculating the remuneration proxy for those particular fringe benefits. The second one is just the extension of the learnership allowance tax incentive. For those of you who are claiming it, it's now just being postponed to the end of March. So any learnership agreements entered into on or before the 1st of April 2027. So this has just been extended. Thanks, Johan. So now to get to the changes that might impact the systems. Now, the first one, you all are aware of the savings spot withdrawal benefit. Remember, from September 2024, employees or members of a fund are allowed to withdraw some of their savings from the retirement funds. So that has already been happening, and the funds have to apply for a directive. It's not the employer themselves. The fund applies for a directive from SARS to determine the pay-as-you-earn, and that withdrawal amount must be reflected on the payroll against Code 3926. So funds in terms of the Income Tax Act is basically, or more specifically the 4th schedule, is seen as an employer, and that is why there's an IRB 5 code. So the fund must reflect the savings spot withdrawal on that particular IRB 5 code. The change in legislation that affects our systems and you as an employer, or just to explain to the employee, is the savings withdrawal is not subject to STL and UIF, which makes sense. It is a fund payment, so it's so the legislation just now clarified that it's not subject to STL and UIF. The next one, the ETI monthly remuneration, which might affect quite a lot of you. Now, the definition of ETI monthly remuneration, and I'm not going to go into all the detail of the ETI calculation, the gross up calculations, etc. But the basis of our calculation of the ETI, the actual amount that the ETI should be, depends on what the employee's remuneration is. So ETI remuneration, so remuneration for the purpose of calculating ETI, and that is a very specific amount. Now, the legislation has clarified what the remuneration should be, but our systems have already calculated or provided for this particular calculation that the legislation is now very clear on since March 2022. And that's why I'm not going to go into too much detail. But I did want to mention it under system changes because I do want you to go and double check that you understand and that the ETI remuneration is in fact calculated correctly. I'll get to that just now. The main reason is the fact that there will be penalties if the remuneration amounts aren't correct, and the ETI amounts are subsequently calculated incorrectly. So effectively from March 2022, and now just clarified in the current legislation, is to say remuneration is basically all the remuneration. In other words, it would be your taxable remuneration. It doesn't include non-cash benefits. So typically your fringe benefit does not get included in the ETI remuneration. And then we have to deduct deductions not allowed as per the BCA, section 341B to be specific. Now, the reason for this change, and the wording of just as a note, the wording is slightly differently, but this is in essence what it means. You'll see it doesn't read it easily, but that is basically, it's your remuneration, doesn't include fringe benefits, but you have to reduce the remuneration with deductions not allowed in terms of the BCA. The reason for this change is National Treasury picked up that there were a few training institutions that would basically provide training to an employee. The employer will go, or they will pay an employee, they will deduct money from the same employee, and they will pay a training institution to provide training, and the employer will claim ETI. But in essence, this employer never actually employed the employee. It's someone getting training at a training institution, which is not really, in fact, employed by me as the employer. So the reason, and if I can just give you an example, let's say the ETI remuneration used to be, let's say, 6,500. I pay this person 6,500. Well, slightly lower because of those brackets, but for the purpose of the example, it's 6,500. So ETI theoretically should be claimed on 6,500. But then if they deduct the 6,500, pays it over to the training or the training institution, then the law says now you have to deduct that because it's not necessary in terms of the BCA. If it's not allowed in terms of law, a contract, etc., then you can't just deduct the amount. So if that is not allowed in terms of the BCA, then you have to reduce the ETI remuneration. So let's say I would give him 6,500, but now because I deduct something that is not necessarily in line with the BCA, now I have to deduct the 6,500 because I'm deducting it from his remuneration. So it reduces my ETI remuneration then effectively to zero. So then there would be no ETI calculator, but ETI remuneration, and therefore no ETI. Again, I'm just using 6,500. I'm aware of the actual amounts being, too high, but it's just for the purpose of for you to understand the effect of reducing the ETI remuneration. Now, systems or payroll systems generally won't know which deductions are allowed in terms of law, because we won't know if it's a birthday fund or a union contribution, for example, because not everything is reported against an IRP5 code. So yes, it would have been easier if everything was reported against a specific IRP5 code, but that is not the case. So it's the user's responsibility to go and determine and indicate those deductions that are not allowed in terms of the BCA, so that it will reduce the ETI remuneration and that we don't calculate more ETI remuneration as what we're supposed to calculate. And again, as I've mentioned, there will now be penalties if we don't calculate ETI correctly. So I want to encourage you to go and double check that the ETI remuneration is set up correctly. You've indicated your deductions, which are not allowed as per the BCA, so that it reduces the ETI remuneration. And while you're busy checking that, also ensure that non-cash benefits are also excluded from the calculation of the ETI remuneration. Now, generally, payroll systems will exclude it because we can link it to IRP5 codes of fringe benefits and exclude those fringe benefits. But there are certain elements or certain income codes that could be cash and non-cash. If I can give you an example of that, Code 3701 would be applicable to a travel allowance, the cash, but then a petrol card is also reflected on code 3701. But if it's a petrol card, it's a non-cash benefit, so it should be excluded then for ETI remuneration purposes. So go and double check that the ETI setup is correctly. If you need to, go and refer back to the notes of March 2022 or ask the support teams or your partner, but just double check that this is set up correctly. You can go to the next slide. Thanks, Joanne. And I hope that makes sense. Other changes, the national minimum wage have changed with effect from March. And this also has an impact on ETI because the minimum wage is used to determine whether the employee actually qualifies for ETI. So please ensure that you are processing the correct rate per hour for all the employees as per the latest rates. And then as a side note, you would have also probably seen over this weekend the BCA earnings threshold increased for employees, which means that certain sections of the BCA won't be applicable to them. So just take note, but there are notifications on our community hub. And then the last one that I want to get to, and the most important one, because this is brand new and it will affect all our payrolls, is refunds or repayments to employers. Now, this is basically a new tax deduction that will be effective. If I speak about a tax deduction, and I know it's not necessarily the correct terminology, we're supposed to speak about just deduction, but just to clarify between just the refund or the actual repayment, I'm going to just speak about the tax deduction quickly. So tax deduction reduces my remuneration to get to balance of remuneration, which is used to calculate STL and pay as you earn. Currently, we have two tax deductions: retirement fund tax deduction. So, or if I contribute to any retirement fund, there's a tax deduction, and then donations. If I donate money to certain institutions, then it also could qualify for a tax deduction. And the tax deduction basically just means, let's say I get a salary of 20,000, I'm supposed to be taxed on 20,000. So if I contribute, let's say 2,000 towards my retirement fund, for example, then it reduces. I'm not taxed on 20,000, but I'm taxed on the 18,000. So after considering the tax deduction for my retirement fund. So now going forward from March, we will have 3 tax deductions. So the third one being introduced now is where the employee needs to repay the employer an amount that was previously included in the taxable income of their employee. Now, typical examples is basically where, let's say, for example, I was on maternity leave and I have an agreement with the employer that I will work for a certain amount of time after I return from maternity leave. But if I don't work another year, for example, then I need to repay the amount. A retention bonus, if I receive a retention bonus, I was taxed on that retention bonus, but now I don't work the agreed period after receiving it, I resign, and then I need to repay the retention bonus. In the insurance industry, where it's a broker that when the policy lapses, they need to repay the commission. So those type of examples I'm talking about, where it was included in taxable income correctly, and now I need to refund the employer. Now, what would have happened was the employer would previously issue a letter. So once the employee repaid the amount, they would issue a letter to the employee stating that they've repaid the amount. And then on assessment, the employee would be able to claim the tax back. But now, instead of the employee having to wait until assessment, we can apply the tax deduction on the payroll. Now, the tax deduction will be limited to the remuneration for the month during which the refund is deducted. For example, if I have remuneration of 20,000 Rand this month, but I have to repay 30,000 of the previous retention bonus that I received, then obviously it should be cut to the remuneration that month, the tax deduction. So I would subtract an amount from the employee, or it's a bank-to-bank transaction where I repay the employer. Either way, I can get the tax deduction on the payroll, and the deduction cannot be more than the remuneration, and the tax deduction cannot be more than the remuneration in the current month. And then any excess that you can't deduct in that particular month can be carried forward to a next month. So if I only have 20,000 remuneration, I get a tax deduction of 20,000, for example. Now I still need to repay 10,000, so that can be carried forward, and the tax deduction can be provided to me in the following month of the 10,000, the remaining 10,000. At this point, the employers must manage this. The repayment amount and the tax deduction should not exceed the remuneration. And to be honest, there are quite a few aspects of this, the application of this deduction, that must still be finalized. So we're working closely with SARS as part of the Payroll Authors Group of South Africa to just clarify final bits and pieces so that we know exactly how it must be applied. So I would encourage you to also keep an eye on the release notes, on the community hub. The more information we have available to us, then we will communicate that. And it's our current understanding that this will not be applicable to administrative errors, for example, where I've overpaid overtime in error. So it would mainly be the examples that I've explained, where there's a breach in contract, for example. It was correctly included in my taxable income or my remuneration, and now I need to refund the amount. So you can go to the next slide, please, Johan. So if I can quickly just give you an example. See, I'm running out of time. An employee received a retention bonus of 3,000 with the condition of him completing an additional year of service, but then the employee resigned, and then next action, the final month of employment is April. And now the employee says to the employer, it's fine, you can just deduct the 3,000 on my last payslip, which is April. Now, if I'm going to use the same example, March, April, I get salaries of 10,000. But in April, I need to repay the 3,000 of a bonus that I've got in the previous year. Now, you will see the code. I've indicated the code 4042 because that's the code we must reflect the deduction on, but I've marked it in red because we still need clarity from SARS as to exactly what they want. Do they want the actual repayment, the full amount the employee repaid, or the tax deduction? So in other words, the portion that was considered before calculating pay as you earn. But we'll keep you up to date with that. So if we look at the example, March, my salary was 20,000. In April, it's 20,000 again, but now there's a tax deduction of 3,000. My remuneration for the month still stays 20,000, so it's my full salary. But then I deduct my refund or repayment to calculate my balance of remuneration, which in this case you can see is 17,000, making my year-to-date balance of remuneration 37,000. So it would be the 20,000 for March plus the 20,000 for April minus the 3,000, this gets to 37,000. And the reason why I show this to you is I want to remind you that your balance of remuneration, so the 17,000 for the month or the 37,000 for the year, is used to calculate your pay as you earn and STL. So you can see the tax benefit that you would have received. But then on your remuneration, the 20,000 for the month is what UIF and ETI and the allowable tax deduction for retirement funds are calculated on. I know in practice, in some instances where, for example, it was in the same year, let's say in March, I received a retention bonus, and in April, it needs to be repaid. Some employers have just simply reduced the RB5 code. So let's say the retention bonus in April would have been a negative 3,000, simply reducing the relevant RB5 code, and then it would have sort of corrected the UIF and everything else, but it's not the correct way necessarily. So this is according to law where we have to. So the UIF is supposed to be calculated on 20,000 and not on 17,000, and makes sense in terms of the benefits for UIF, etc. So again, keep an eye on all the channels and the release notes where we will give more detail. It's not a lot of time to just explain this concept, but at least you know what to expect. Also be sure to attend if it's possible, to attend the annual payroll tax seminar or webinar that Rob Cooper is presenting, where he will go into depth with all these details, explain all the scenarios, and hopefully we'll have more information soon and confirmations from SARS, and then you'll have more detail. And I think that's it from you. Then we'll see what happens tomorrow, holding thumbs that all goes well and goes ahead. If you have any questions for me, you're welcome to pop in the chat and I'll see if we have time. I doubt it, Joanne, but if we have time, then we can answer those questions. But that's it from me. Thanks, Joanne.
Thank you so much, Yolandi. I appreciate all this wonderful information you shared with us. And yeah, definitely looking forward to what might be a very exciting budget speech. I see there are quite a number of people that have raised your hands. I'm really sorry we don't have time for a Q&A right now.
Johan, sorry, can I interrupt you very
please...
quickly?
Yes.
Those hands are raised. I just asked in the chat if people could stick on for a few more minutes just so that we've got an extra time. So I think for the majority, we've got about 15 minutes.
Okay, perfect.
And I got worried, Lucy. I thought it was only just compliance questions.
I know.
Got excited there for a bit too.
What we will do for those of you who can't stay on, and we totally appreciate that, is we are recording. We will compile a Q&A for you. So I promise you won't miss too much. But Johan, yeah, if you want to take over, please carry on. Thank you.
100%. I don't think I would need 15 minutes altogether. But I do appreciate if anyone could potentially stay on. I also want to encourage you to please post any questions or any comments in the chat function or in the Q&A section. And like Lucy said, we would happily compile answers to those questions after the session then. So from a system change, from a product change, for Sage 300 people, 2025 1.1.3.0, with the budget speech being postponed to the 12th of March, we expect that 25.1.3.0 will be publicly available on the 18th of March. Now, this is unfortunately pending whatever changes they introduce, but I don't think anyone is really expecting too big of a bomb to drop tomorrow. So I'm relatively confident that we should be able to retain that date and to release as planned. The update will be made available through the Sage portal. If you do not have direct access, your business partner would. So please feel free to reach out to your business partner to have this update installed as soon as possible. I also understand that there is, with a lot of customers, due process where this needs to go into a user acceptance testing phase first. And we had a question earlier around what do I do? So you are able to process using the existing tax tables, but you also need to consider the ramifications of each individual scenario. So as an example, if you are processing weekly employees, you would have already paid them with tax calculators on previous tax tables. And this would effectively just mean that in the coming periods, that tax would need to correct itself. There are a lot of variables. I don't think we can run through all of them, but it is something that's doable. You just need to take a minute to consider your options. One thing I do want to encourage or promote is I want to encourage you to go and register on the Sage community. It takes 2 minutes to create a Sage ID that links to your Sage account and that gives you access to the Sage community. And the Sage community is the platform where we communicate all important information, such as the product updates, if there's a delay or if there's if it's been fast-tracked, any kind of release notes, compliance notices, all of that information is communicated on the Sage community as a central place or a single source of truth for you to find any information that you might need. To quickly highlight a few of the bug issues that we corrected in 2025-130. There was an employee display name that was incorrect on the Payslip PDF API that has been corrected. Job costing batches was in certain cases not adding up to 100%, and that has been enhanced to look at a broader scope of variables. The Saudi Arabia final settlement report was not responding if you used the click once. It has been corrected. The BEE 123 integration returned a passing value in some instances, and that has been addressed as well. The database connection timeout period has been increased to allow for more connection strings. And there was duplications on the payroll analysis with employee details noticed in certain cases as well. That has also been addressed to broaden that scope a bit. Some key legislative points that I want to just raise that Yolande has already spoken to, most of them at least, is the tax tables coming out hopefully tomorrow. The prescribed rate per kilometer, it's something you need to be aware of, something you need to make sure it's been corrected when you're paying out those values, and the source code 4042 that has been introduced. One other thing that is not particularly for South Africa is the United Arab Emirates GPSSA calculation has also been updated with the latest limits. Something we don't necessarily need to discuss, but I wanted to point out is that there have been a significant amount of GenTax files released for Upper Africa and for Middle East that has been made available through the Sage portal. If you are still awaiting some of them, please go and have a look. I'm sure it would be available. I think since compiling this deck, there's been 3 or 4 further updates that I will add onto the slide deck before sharing it with everyone. And that is me. Short, sweet, powerful. Again, if you have any questions, please post it in the chat. I'm happy to take time to compile some answers. I see there's been quite a few comments that have come through. I've not read through them yet. Thank you to everybody that is helping with the responses. Yes, Lucy.
Sorry, Johan, I was just going to say there are a couple that I think might be applicable to discuss now, if it's okay.
Perfectly fine. I mean, you did buy us an extra 15 minutes.
I did, yeah.
I'm happy to.
Magically, it cost me a fortune, but it's okay. I bought it. Quick 2, I think that might be relevant to everyone. So the first one is what will happen if the update is not done on the 19th of March, 18th of March. We release our payroll on the 19th to be paid to staff on the 20th. I think we had this in the earlier call as well.
So yeah, so like I explained, I mean, there are a bunch of variables that we can't necessarily all cater for in this call, that we can't all discuss. It's something that you would need to take the time to consider. There is an inherent risk, for example, if an employee resigns before the tax is corrected in a future period. But again, we're not talking about jail time necessarily. We're talking about a few $100 here or there that might be that they might claim back from SARS when they do their tax submission. Other than that, each case is relatively unique, so it is something that you would need to consider. But it is possible to process those payrolls on the previous year tax tables. And once the new tax tables have been installed, the tax will auto-correct itself. It will adjust to accommodate what was over or underpaid in the previous period. Remember, when calculating tax, it looks at your year-to-date earnings and your year-to-date deductions. So it looks at a broader scope other than just the existing period that you're in. So yes, you can do that, especially considering with Sage 200 people, a lot of customers have UAT environments or QC environments that they first install and that needs sign off in certain cases. In those type of scenarios, I would absolutely recommend that you don't put yourself under unnecessary pressure and rather consider processing on the previous tax tables. Sorry. I see another question up there. Will MCS automatically be updated? I would like to say it's automatically, but in fact, it is a guy that's sitting in the background and physically applying the update. Very late at night. So typically what happens is the MCS platform or the Azure platform has downtime on a Friday night. So what we normally do is we apply the updates on a Friday night for MCS as well. In this particular case, the first Friday that will have downtime is the Friday following the 19th, which is the 21st. So MCS will effectively be updated the 21st. Now, in saying that, we are trying to see if there is not a way we can fast track this without creating a bad user experience.
Thanks, Johan. There's a quick one here from Andrew. What do we do in the case when payrolls are already closed and then the tax tables have been updated?
Okay. In that type of case, you've already printed your pay slips, you've already paid your employees, roll over to your next period in order to solidify the period that you've already closed off, and then update into your latest tax files. If your period has already been closed off, it will not apply the new tax tables for that period. So roll over to your next period and rather let the tax correct itself there.
Perfect, thank you. And I think if we have got time for one more from Yaku, in terms of a lowered reimbursable rate, I assume the system will not be able to run a backdated calculation on any transactions that have been processed on the R4.84 rate before the update. How do we go about rectifying this? Do we need some time to think about that?
I'm going to phone a friend on that one.
Yeah.
Yaku, I think I would appreciate if you can drop your contact details in the chat. Or Lucy, I think we might have the contact details on the registration, if I'm not mistaken. I would rather have the people that specialize in those calculations give you a call, or at the very least advise me on how to correctly advise you.
Perfect. I think that is almost us. Yeah. So if anything else comes through, the chat should be open for the next, I think it's 30 minutes after the call. And we can just do a quick compilation and crack on with whatever else anyone needs to ask.
Brilliant. Thank you so much, everybody. I really appreciate your participation. I appreciate your engagement in this discussion. All the questions, all the comments, very much appreciated. I appreciate your time. I know it's a bit of an odd time on a Tuesday, but it is worthwhile, especially hearing all the compliance changes and what's coming up in the updates. Lucy, thank you so much for arranging these sessions and for sending out the invites. And Yolandi, thank you so much for all the wonderful information on compliance that you've shared with us.
Thanks so much, Yaku. Thanks, everybody. Yaku, Jan. You know, it starts with a J.
Close enough.
We'll chat to everyone again soon. Thank you so much.
Thanks, guys. Goodbye.